A buyback is a company betting on itself. Intel spent $82 billion on that bet. Last Monday, it did the opposite. On August 10th, Intel told the market it wanted to sell $15 billion of new stock. It had not done that since 1971. Retail investors read the word dilution and sold. The stock fell more than 3% before the opening bell and kept falling, down to $96.30. By Tuesday, the same deal had $100 billion chasing it. One of those two groups read the deal wrong: the small investor who sold on Monday, or the institution that bid on Tuesday. One of them was looking at something the other wasn't. The answer is a number, and the United States government paid it for Intel stock last August. First, the money Intel already had. Through the 2010s, Intel bought back $82 billion of its own stock. That is about 4 years of everything Intel now spends on factories, handed to shareholders instead. Russ Mould is investment director at A.J. Bell. He told Reuters that Intel damaged its own prospects by choosing, in his words, financial engineering rather than physical engineering. Intel is printing stock again now at about 5 times the price of a year ago. This is what Intel actually sold: 210 million shares priced at $95 each. That comes to $20 billion to the dollar. 20 banks are named on that press release. 4 of them led the book: J.P. Morgan, Goldman Sachs, Morgan Stanley, and Citigroup. The gap between the $20 billion Intel sold and the $19.7 billion it keeps is fees and expenses. That is roughly $300 million. The banks also hold a 30-day option on another 31 million shares at the same price, which would take the deal to $23 billion. It closed on August 12th. Intel needs the money for a reason it has been saying out loud. In July, it raised its capital spending plan for this year to more than $20 billion, up from 18. The chief financial officer, Dave Zinsner, said next year's number will be significantly above that one. Intel also committed to high-volume production on its 14A process in 2028, and Tesla signed on as a customer. Intel had warned that node might never get built without one, so the ask made sense. The response did not, at least not at first. Intel opened the book asking for $15 billion. By the time it closed, investors had put in more than $100 billion of orders, $5 of demand for every dollar of stock on offer. Intel raised the size of the deal by a third to $20 billion and still turned money away. Now go back to Monday morning, to the people on the other side of that book. Retail investors saw a company announce it would print new shares, which makes every existing share a smaller slice. That part is real. Intel had just over 5 billion shares outstanding in July. 210 million more works out to about 4%. So they sold. The stock fell more than 3% before the bell and traded near $96.30 during the day. By Tuesday evening, institutions had bid $100 billion for that same paper. Both groups had the same press release. Only one of them had a price. The institutions may simply be right about the company. Intel's second quarter was its fastest growth since 2011, $16.1 billion of revenue, up 25%. Data center revenue rose 59% to $6.3 billion. Intel says it cannot make chips fast enough to fill the orders it already has. It has signed 10 long-term contracts with server buyers on fixed prices or guaranteed volumes. The stock is up about 164% this year. Against all of that, 4% of dilution is a cheap way to fund a factory. A buyer at 95 is not obviously wrong. But the buyer at 95 was not paying 95 for Intel. Intel had traded at 101.65 before the announcement. The offering priced 6.5% under the market. The discount was the product. You cannot get an allocation through a brokerage app. You get called, or you don't. It went to the institutions that got that call, and to the 20 banks named on the release. It did not go to the person who sold on Monday, and it did not go to the largest shareholder of all. Last August, the United States government bought 433 million Intel shares. It paid $20.47 a share with unspent CHIPS Act money, 9.9% of the company. This month, the government bought none of the new stock. Its stake was diluted with everyone else's. When the government bought in, Intel's own release said the price gave American taxpayers a discount to the market. 11 months later, the discount went to the book. On paper, the government did well. 433 million shares bought at 2047 are worth about $41 billion at 95. That is roughly $32 billion of gain the Treasury has not sold and has not collected. It is a mark, not a check. What Intel did is simpler to state. It spent $82 billion retiring its stock in the decade it was winning. It has now raised back about a quarter of those dollars by printing stock at 5 times last year's price. Intel's own filing says the money is for general corporate purposes, which may include capital expenditures and working capital. That is the entire stated use. Intel is not telling anyone which factory the $19.7 billion buys. The market did not appear to need telling. It bid 5 times the stock on offer, at a price it would not get twice. On Monday, the small investors sold the dilution. On Tuesday, the institution bought the discount. Both were reading the same page. Every filing is linked below. Follow the compute.